France, the oldest ally the United States has ever had, the country that sent Lafayette to fight beside Washington at Yorktown, the country that gave America the Statue of Liberty, quietly withdrew every single ounce of its gold from the Federal Reserve Bank of New York between July 2025 and January 2026. 129 tons, roughly $15 billion worth, shipped from the vaults in Lower Manhattan to Paris without a press conference, without a formal announcement, without a single word from the LEC Palace, explaining why the nation that had trusted the American financial system with its gold reserves for decades suddenly decided that trust was no longer warranted. Fortune magazine reported the withdrawal this week and placed it in the context of what they described as a phenomenon that is different from anything in the past 80 years of dollar dominance. America's allies, not its enemies, are pulling away from American financial systems. Canada announced a $25 billion sovereign wealth fund, explicitly designed to make its economy less dependent on the United States. Germany's former Bundesbank head of research warned of growing tensions over reliance on dollar-denominated systems. And a 21-mile-wide sliver of water called the Strait of Hormuz, which carries 20% of the world's oil every single day, is now partially operating in Chinese yuan because Iran is collecting transit tolls in a currency that is not the dollar, from ships that are carrying oil that used to be priced exclusively in dollars, through a waterway that the United States Navy was supposed to guarantee but cannot currently control. Richard Wolff, one of the most cited economists in the world, sat down last week and said the words that no American wants to hear. He said, "These are the mistakes a declining empire makes, and these are the mistakes that accelerate the decline." He was not talking about a future possibility. He was describing what is happening right now, this week, in real time. And I am going to walk you through every piece of evidence, from the bond market to the battlefield, that proves it. Because what happened this week was not a bad week for the American economy. Bad weeks happen, recessions happen, crises happen, and recoveries follow. What happened this week was structural. It was the week where the pillars that have held up American global dominance since 1945, military credibility, financial monopoly, institutional trust, allied loyalty, and fiscal sustainability, were all visibly cracking at the same time, in the same news cycle, documented by the same institutions that built their credibility on being cautious and conservative in their assessments. When Fortune and CNBC and NPR and the IMF and Deutsche Bank are all publishing analyses that use the word decline in the same week, the word means something. It means the mainstream has caught up to a reality that the data has been showing for years. America's oldest allies are moving their gold and their money out of the American system, and they are doing it now. Fortune reported this week that the de-dollarization push is no longer being led by America's adversaries. It is being led by America's friends. France's gold withdrawal from the New York Fed was not an act of hostility. It was an act of precaution. The oldest ally, America, has decided that storing its national reserves inside the American financial system carries a risk that it did not carry 5 years ago, and France replaced the gold with updated bullion and stored it in Paris, making $15 billion from selling its old stockpile. Canada's Prime Minister Mark Carney announced a $25 billion sovereign wealth fund designed to bolster domestic infrastructure as part of an explicit effort to reduce Canada's economic dependence on the United States. Canada, the country that shares the longest undefended border in the world with the United States. The country whose economy has been structurally integrated with the American economy since NAFTA in 1994. That country is now building financial infrastructure specifically to insulate itself from American economic decisions. And David White, a historian at the University of North Carolina at Greensboro, told Fortune that the increasing aggressiveness of the United States in multiple fields, both in terms of sanctions and warfare, has caused more countries to wonder whether they want to be completely tied to or dependent on the dollar if things go sour. The dollar's share of global foreign exchange reserves has fallen from 71% in 1999 to 57% today, a 25-year low according to Fortune. During the past 20 years, the U.S. has imposed approximately 70 active sanctions regimes affecting more than 9,000 individuals, companies, and economic sectors, more restrictions than the EU, United Nations, and Canada combined. Every sanction is a demonstration of the dollar's power. And every demonstration of power is also a reminder to every other country on Earth that they are vulnerable to American financial decisions. The sanctions on Russia following the Ukraine invasion were supposed to demonstrate American strength. Instead, they demonstrated American risk. Countries watched Russia's reserves be frozen and asked themselves the obvious question: if America can freeze Russia's money, can they freeze mine? And the answer is yes. Technically, legally, Operationally, the United States can freeze or restrict any dollar-denominated asset held within the American financial system. That capability, which was supposed to deter adversaries, is now driving allies to build alternatives. France moved its gold. Canada built a wealth fund. And the trend is accelerating because the Iran war has demonstrated that the United States will use military force in ways that destabilize the global energy system on which every country's economy depends. The allies are not angry, they are rational. And rational actors diversify away from concentrated risk. America has become the concentrated risk, and the evidence is not limited to gold withdrawals and sovereign wealth funds. Emanuel Monk, who served as head of research at Germany's Bundesbank, warned in January that tensions with the United States have created structural concerns about the reliability of dollar-denominated systems. Germany, the largest economy in Europe, the anchor of the Eurozone, the country whose post-war reconstruction was financed by American capital through the Marshall Plan, is now publicly questioning whether the dollar system serves its interests. Japan, America's closest military ally in Asia, has been quietly diversifying its reserve holdings for years, increasing its allocation to euros, gold, and the Chinese yuan. South Korea expanded its gold reserves by record amounts in 2024 and 2025. India has been purchasing gold at unprecedented levels through the Reserve Bank of India, building physical reserves that exist outside the dollar system entirely. The central bank gold buying that has been running at record pace for 4 consecutive years is not a speculative trade. Central banks do not buy gold for short-term returns. They buy gold when they lose confidence in the alternative, and the alternative they are losing confidence in is the dollar and the system that denominates it. Gold crossed $4,500 per ounce recently, approximately triple what it was just a few years ago, and gold priced in euros and yen also hit records, which means this is not simply dollar weakness, but a global flight from sovereign paper into physical metal. That price movement is the market's verdict on the credibility of the institution that manages the dollar, and the verdict has been delivered not by America's enemies but by its own financial partners, who have watched the sanctions regime, the Iran war, the fiscal trajectory, the credit downgrades, and the political capture of the Federal Reserve, and concluded that the risk of remaining fully exposed to the American financial system now exceeds the cost of building alternatives. Iran is collecting tolls in Chinese yuan through a waterway America was supposed to control, and the petrodollar is cracking. NPR reported 4 days ago that ships have been transiting the Strait of Hormuz by paying tolls to Iran in Chinese yuan. Al Jazeera confirmed that Iran and China have seized the opportunity presented by the war to address their shared goal of ending the hegemony of the US dollar in global oil trade. Deutsche Bank published a note predicting the rise of what they called the petroyuan as a result of the Hormuz crisis. And CNBC reported that strategists are now debating whether the dollar is in structural decline, with Deutsche on one end seeing permanent erosion and Franklin Templeton on the other seeing no viable alternative. That debate between structural decline and temporary wobble is itself evidence of the shift. 5 years ago, there was no debate. The dollar was the global reserve currency, period. The fact that Deutsche Bank, one of the largest financial institutions in Europe, is publishing research notes predicting the rise of an alternative oil pricing currency is a development that would have been unthinkable in 2020. And the mechanism through which it is happening is precisely the mechanism that Fortune described in their March 2026 analysis. Every week that the strait stays closed, Asian economies are forced to test alternative supply chains and, at the margin, alternative payment mechanisms. If the crisis is resolved in weeks, those experiments are abandoned. If it drags into months, habits begin to form. The crisis has now lasted more than 2 months. The habits are forming. China purchases nearly all of Iran's oil, and their bilateral trade is conducted in yuan because Iran cannot access the dollar system due to sanctions. Hosuke Lee Makiyama, director of the European Center for International Political Economy, told Al Jazeera that China is perhaps the closest the world has seen to a manufacturing one-stop shop, meaning that oil-producing countries that shift to yuan can actually spend those yuan on Chinese goods in a way that was not possible with previous dollar challengers. The euro failed to displace the dollar because Europe could not supply oil-producing countries with everything they needed to buy. China can. That is the structural difference that makes the yuan challenge different from every previous challenge, and the Hormuz crisis is the catalyst that is forcing the experiment to happen at scale, under pressure, with real money and real consequences. Saudi Arabia chose not to formally renew the petrodollar agreement in June 2024. The informal, secretive nature of the deal makes it difficult to evaluate whether that was a policy change or a formality. But the fact that the agreement was allowed to lapse without renewal during a period of deteriorating U.S.-Saudi relations is itself a signal. The Saudis still price the majority of their oil in dollars, but the word majority is doing work that the word exclusively used to do. And the distance between majority and plurality and minority is the distance that empires travel on the way down. Kenneth Rogoff, the former chief economist of the International Monetary Fund, was quoted by Al Jazeera saying that Iran is dead serious about preferring yuan to avoid U.S. sanctions and to cultivate its ally China, which has been moving steadily to redenominate its own trade and that of the BRICS nations into yuan. BRICS, the economic bloc that now includes Brazil, Russia, India, China, South Africa, Egypt, Ethiopia, Iran, and the UAE, represents approximately 46% of the world's population and roughly 36% of global GDP at purchasing power parity. The expansion of BRICS in January 2024 to include 4 Middle Eastern and African nations was a deliberate statement of intent to build economic architecture that does not depend on the dollar. And the yuan share of global reserves, while still small at approximately 2.1%, is growing from a base that did not exist a decade ago. The euro holds roughly 20%. No single currency has emerged as a clear replacement for the dollar, which is what allows defenders of dollar dominance to claim that the system is secure. But the decline does not require a replacement. It requires fragmentation. When the global reserve system shifts from one dominant currency to several competing currencies, each serving different blocks and different trade relationships, the United States loses the exorbitant privilege of borrowing cheaply in its own currency from the entire world. The shift from monopoly to oligopoly does not require the dollar to disappear. It requires the dollar to share, and sharing for an empire built on exclusive financial dominance is the beginning of the end. National debt crossed $39 trillion on March 18th, and the Treasury must borrow $2 trillion this year just to keep functioning. On March 18, 2026, 3 weeks into the Iran war, the United States national debt crossed $39 trillion. Fortune reported that the most recent trillion was added in roughly 5 months. The debt now totals approximately 125% of GDP, up from 36% in 1981. The Congressional Budget Office reported in February that the annual budget deficit will likely reach $1.9 trillion this year and grow to $3.1 trillion by 2036, creating a projected $64 trillion national debt within a decade. And Fortune reported that the U.S. Treasury will have to borrow $2 trillion this year just to continue functioning. More than $166 billion every single month. That number is so large that it has ceased to register as meaningful to most Americans. So let me translate it. Every month, the United States government borrows roughly the GDP of Bangladesh just to keep the lights on. Every year, the United States government borrows roughly the entire GDP of Italy just to fund the gap between what it collects in taxes and what it has already promised to spend. And the borrowing depends on buyers. The Treasury issues bonds. Someone has to buy them. For decades, the primary buyers were foreign central banks, particularly China and Japan, and domestic institutional investors. China has reduced its treasury holdings from $1.3 trillion to approximately $760 billion, a 42% reduction. Japan has been a more reliable buyer, but is constrained by its own monetary policy challenges. And the domestic buyer base, pension funds, insurance companies, and mutual funds, is reaching capacity limits as rising interest rates have reduced the market value of the treasuries they already hold. When there are not enough buyers at the current yield, the Treasury has to offer higher yields to attract them. Higher yields mean higher interest payments. Higher interest payments increase the deficit. The larger deficit requires more borrowing. More borrowing requires more buyers, and the cycle accelerates. Interest payments on the national debt have now crossed $1 trillion per year, exceeding the entire defense budget. President Trump has called for increasing the fiscal year 2027 defense budget to $1.5 trillion, which is 50% more than the $1 trillion he previously wanted to propose. The math of borrowing $2 trillion per year, while spending $1.5 trillion on defense, while paying $1 trillion in interest, while running a war in the Middle East, while the credit rating has been downgraded by every agency on Earth, while allies are withdrawing their gold from the Federal Reserve, is the math of a country that has lost control of its own fiscal trajectory. And the bond market knows it. Treasury yields surged in March with the 10-year yield rising toward 4.4%, its highest since mid-2025. Richard Wolff warned that if Gulf states begin selling their treasury holdings to cover losses from the Hormuz closure, the resulting fire sale would spike interest rates further at exactly the moment the economy can least absorb it. Oil hit $125 a barrel last week, and gas is at $4 and the strait is still not open and nobody has a plan. In these times reported that oil prices reached a 4-year high of more than $125 per barrel last week. Average gas prices surged more than 30 cents in a single week to reach $4.45 per gallon, roughly $1.50 higher than the pre-war average. Traffic through the Strait of Hormuz remains a tiny fraction of what it was before February 28th. And as of this week, Iran has effectively institutionalized its control of the waterway by establishing a toll system and negotiating a joint maritime protocol with Oman that would embed Iranian authority over the strait into a standing bilateral agreement. Former Defense Secretary James Mattis warned at the CRO Week conference that if the strait remains under Iranian influence, you would see a tax for every ship that goes through. That tax is now operational. Iran is charging over $1 million per ship, and the ships that are paying it are paying in yuan, not dollars. The United States Navy, the most powerful naval force in the history of the world, has been unable to reopen the strait in over 2 months of trying. Trump declared a naval blockade on April 13th. Central Command sent destroyers in for mine clearance operations on April 11th. Iran reportedly lost track of some of the mines it planted, meaning the strait cannot be fully cleared even with Iran's cooperation. And the administration has cycled through what Fortune described as increasingly desperate options, from building a naval coalition with about 7 countries to a reported proposal to wind down the conflict without resolving the Hormuz closure at all. The United States entered the 21st century as the unchallenged guarantor of global maritime security. The ability to keep shipping lanes open, to project power into any ocean, to ensure that oil flowed freely from producer to consumer was the military foundation of American economic dominance. That foundation has cracked, not in theory, not in a war game at the Naval War College, in reality, in the Strait, where 230 tankers sat for weeks with nowhere to go while the most expensive navy on earth could not clear a path for them. And every country that depends on oil from the Gulf watched it happen. Every shipping company that routes vessels through the strait watched it happen. Every central bank that holds dollars because the dollar is backed by American military credibility watched it happen. And what they watched was the moment when the gap between American military capability and American military effectiveness became visible to the entire world. The capability exists, the aircraft carriers exist, the destroyers exist, the missiles exist. But the effectiveness, the ability to translate that capability into an open strait with freely flowing oil priced in dollars, does not. And that gap is the gap through which empires fall. And I want to put the military credibility issue in historical perspective, because what happened in the Strait of Hormuz this spring is not just a tactical failure. It is a strategic revelation. The British Empire maintained global dominance for over a century through the Royal Navy's control of maritime choke points, the Suez Canal, the Strait of Malacca, the Cape of Good Hope. The ability to guarantee the free flow of commerce through those choke points was the foundation of British commercial and military power. The moment the British could no longer guarantee Suez, in 1956, when Nasser nationalized the canal and the United States refused to support British military action to retake it, the British Empire was effectively over. Not because Britain was militarily weak, because the credibility of British guarantees was destroyed by a single demonstrated failure. The Hormuz crisis is America's Suez moment. The United States has guaranteed freedom of navigation through the Strait of Hormuz since the tanker war of 1987 to 1988. For 38 years, the implicit promise was that the U.S. Navy would keep the oil flowing. That promise was central to the petrodollar system, to the security guarantees that kept Gulf states aligned with Washington, and to the confidence that allowed global shipping companies to route trillions of dollars in cargo through a 21-mile gap with minimal insurance costs. The promise is broken. Not permanently, not irreversibly, but visibly. And in geopolitics, visibility is everything. The countries that watched the strait close and the Navy fail to reopen it for 2 months will make decisions over the next decade that are fundamentally different from the decisions they would have made if the strait had remained open. Those decisions will involve alternative shipping routes, alternative reserve currencies, alternative security arrangements, and alternative alliances. And each of those decisions reduces American influence by a fraction that is small individually but devastating cumulatively. And the economic architecture that maintained American dominance is unraveling simultaneously with the military credibility. The petrodollar system that Henry Kissinger brokered with Saudi Arabia in 1974, the secret deal that replaced Bretton Woods and quietly governed the global economy for the next half-century, was built on 2 pillars. First, Saudi Arabia would price and trade its oil exclusively in U.S. dollars. Second, the United States would guarantee the security of the Saudi kingdom and the free flow of oil through the Persian Gulf. Both pillars are cracking. Saudi Arabia declined to formally renew the petrodollar agreement in June 2024, and the United States has demonstrably failed to guarantee the free flow of oil through the Persian Gulf for over 2 months. The deal that sustained American financial dominance for 50 years is now being violated on both sides simultaneously. And the countries that were not party to the original deal but were beneficiaries of the system it created, Japan, South Korea, Germany, France, the UK, are now watching the system fail and building contingency plans. Those contingency plans, the gold withdrawals, the sovereign wealth funds, the alternative payment mechanisms, the yuan toll collections, are not hostile acts. They are rational responses to the observable deterioration of a system that no longer delivers what it promised. The system promised stable oil prices. Oil hit $125. The system promised free navigation. The strait is blocked. The system promised dollar stability. The dollar is at a 25-year reserve share low. The system promised American military credibility. The Navy cannot open a 21-mile waterway. And the countries that built their economies on the assumption that the system would hold are now rebuilding their economies on the assumption that it will not. Credit downgraded by every agency. Consumer sentiment at record low, and the economy is exhibiting every marker of imperial decline. All 3 major credit rating agencies have now downgraded the United States from AAA, Standard & Poor's in 2011, Fitch in 2023, Moody's in May 2025. The country that was the safest borrower on Earth for over a century is now rated below Germany, Switzerland, Canada, Australia, Singapore, Norway, the Netherlands, Denmark, Sweden, and Luxembourg. 10 countries that most Americans cannot locate on a map now hold a higher credit rating than the United States of America. Consumer sentiment plunged to 47.6 in early April, according to the University of Michigan, the lowest reading in the 75-year history of the survey. Lower than during the 2008 financial crisis. Lower than during the pandemic. Lower than during 1970s stagflation. Lower than after 9/11s. The March CPI showed a 0.9% monthly increase, the largest since May 2022, with energy prices rising 10.9% in a single month. Annual inflation climbed to 3.3%, and economists warn it will rise further as the energy shock cascades through food, manufacturing, and services over the next 60 to 120 days. The IMF cut its global growth outlook this week and warned that a longer conflict could significantly weaken growth and destabilize financial markets. The conference board projected that even if diplomacy prevails, the negative shock is already set in motion, and spillovers will extend into the second half of the year. And the labor market has entered what Stanford called a low-hire, low-fire equilibrium, where nearly 90% of net private job creation occurred in a single sector, and the economy has essentially stopped creating employment outside of healthcare. Every one of these data points would be a serious concern in isolation. Together they form a pattern that historians of empire will recognize immediately. A military overreach that destabilizes the economic system the military was supposed to protect. A currency losing global confidence at the exact moment the government needs to borrow the most. Allies hedging their exposure to a patron that has become unpredictable. A domestic population experiencing declining living standards and record low confidence in the economy. A governing class unable to agree on a fiscal path and unwilling to confront the structural drivers of decline. And a series of foreign policy decisions that convert latent vulnerabilities into active crises. That pattern has a name. It is not recession. It is not downturn. It is decline. On decline is not a prediction about the future. It is a description of the present. The evidence is in the bond yields, the gold withdrawals, the yuan tolls, the blocked strait, the empty SPR, the record low sentiment, the triple downgrade, the $39 trillion debt, the $2 trillion annual borrowing, the $1 trillion interest payments, and the $125 oil that American consumers are paying $4.45 per gallon to absorb, while the country that was supposed to be the most powerful on earth cannot open a 21-mile waterway that separates Iran from Oman. This week proved it, not because a single event occurred that changed everything, but because the accumulation of events reached a density that makes the pattern undeniable. France moved its gold. Canada built its fund. Iran collects tolls in yuan. The IMF warned of recession. The bond market is selling off, and the sell-off is not random. Richard Wolff explained last week the specific mechanism that turns the Hormuz closure into a domestic interest rate crisis. Gulf states hold hundreds of billions of dollars in U.S. Treasury securities. Their sovereign wealth funds are partially invested in American assets. Those countries expected to pay their dollar-denominated debts with dollars flowing from oil and gas exports through the strait. But there are no dollars flowing because the strait is shut and the blockade has restricted even the trickle that was passing. So these countries are being forced to sell their dollar assets to cover domestic spending obligations. A fire sale of Treasury securities by Gulf states would increase supply on the open market, drive down Treasury prices, spike yields, and force the U.S. government to pay even higher interest on the $2 trillion it must borrow this year. The war created the fiscal pressure on the countries whose asset sales would worsen the fiscal pressure on the United States. The snake is eating its own tail, and every week the strait stays closed, the pressure builds. The rating agencies have downgraded, the strait is blocked. The economy is stalling, the consumer is depleted, and the American empire, the 80-year architecture of military power, financial dominance, and institutional credibility that defined the second half of the 20th century and the first quarter of the 21st, is being dismantled. Not by an enemy, by the accumulation of its own decisions. Share this video with every American you know, not for views, because the information in this video has not been assembled in one place by any mainstream source. The individual pieces are scattered across CNBC, Fortune, Al Jazeera, NPR, the IMF, In These Times, Deutsche Bank research notes, and Federal Reserve data releases. Nobody has connected them into a single narrative because doing so requires saying something that no network anchor, no cabinet secretary, and no member of Congress is willing to say out loud. The American empire is done, and this week just proved it. The evidence is not circumstantial. It is documented, sourced, and verified by institutions that have no political motive to fabricate it. The decline is not coming. It arrived, and the only Americans who do not see it are the Americans who have not yet been shown the full picture in one place at one time, until now.